And now for something completely different.
Forget everything you've been told by others before. Get ready for the real deal, the full story, real talk about money, markets, life. Now, it's The Real Investment Show with Lance Roberts, presented by RIA Advisors.
Well, congratulations, you made it to Thursday. It's the second best day of the week. And here we get going through the mid of June. That means we're getting ready to wrap up the quarter. 2 more weeks to go to wrap up this quarter. And of course, now we've got all the important data behind us, right? Inflation data, both CPI and PPI. The Federal Reserve meeting yesterday. Lots of stuff to talk about today, of course. Michael Leibowitz will join me. We'll go through what the Fed said and what they didn't say yesterday, and how the market took it, which was kind of interesting overall. So we'll get into all of that this morning, of course. But a quick update on the markets, though. Not surprisingly, markets continue to remain very, very extended here. And again, this has just kind of been a repetitive statement for the last couple of weeks. Despite all these concerns about a recession and slowing economic data, and certainly valid concerns, I'm not dismissing those at all, the market has really just taken off. After we broke out of that consolidation range, and remember we had talked about this back in May, is that the market had spent about 45 days in a very tight consolidation range. Wasn't really going up, wasn't going down, just kind of stuck. And we said, well, if we break out of this range to the upside, we're going to have a pretty decent move higher. And then a break to the downside, of course, would be a pretty decent move lower. Well, we broke out to the upside, and we've had a fairly decent move higher here over the last 2 weeks. Now, we've talked about this before, what's called a buying stampede. In the markets, you have 2 different types of stampedes. You have a buying stampede and guess what? A selling stampede. Yeah, they tend to work together. What happens is these are periods where buyers enter the market or sellers enter the market, depending on what it is. And these stampedes tend to last about 14 to 16 trading days on average. They can go longer. We've seen them go for longer periods. Right now, we're starting to push kind of the upper end of that range of this current buying stampede. So what does that mean? Well, markets can't just go up indefinitely, right? They have to have corrections. They have to have pullbacks from time to time. And that's just a function of what allows the markets to work over time. If we take just as an example, take a look at a really long-term chart of the S&P, we can see that, the market trends higher over time, but it does so kind of bumpy. There's ups, there's downs, and when the markets get well elevated above a particular kind of a moving average or a trend line, whatever it is, those tend to have like a gravitational pull and pull prices back. So, right now the expectation is this market's just going to keep going higher, and retail investors are now jumping in literally into the pool with both feet. And we're seeing this in terms of both investor sentiment as well as investor allocations to equities, retail investor to equity allocations, all rising really sharply here over the last 2 weeks. Finally, the idea of this bear market is moving behind us. And now investors are going, okay, it's over, got to get back in. And so we're seeing this a fairly aggressive move of retail investors jumping into the markets now, chasing stocks. Of course, they're chasing technology stocks, semiconductor stocks, etc. That's been the real move here as of late. Very similar to what we saw back in 2020 when we had that 35% meltdown in the market. Markets took a little bit of time to start recovering, but once that recovery was underway, and of course, at that time, we had the Federal Reserve doing, quantitative easing and a lot of other supports. Then all of a sudden, investors kind of just dove in head first. And they were buying everything, low-quality stocks, fundamentally weak stocks, etc. All those were kind of the big chase. We're seeing a bit of that same action here again today. That's just a issue of kind of how market dynamics work. But here's the important part that we're getting to. And again, we see this on both the S&P and the NASDAQ. The market has gotten really extended here. Again, we talked about deviations from long-term moving averages. Those are getting to fairly extreme levels here. Relative strength index, of course, that kind of a good measure of markets being short-term overbought, is at levels that typically, you're above 80 on the S&P right now on the relative strength index. That typically tends to be kind of where markets peak short-term, and not just in bear, if this is a bear market still, right? A lot of people still suggesting this is a bear market rally. If that's the case, if we step back and look at the market over the last couple of years, in particular the kind of the bull market period, even then we see that when you get to fairly elevated levels of relative strength, that's typically tends to where you get short-term peaks in the markets, even during a rising bull market. And that's certainly okay because, again, we need opportunities to put allocations back to work in portfolios. And that's kind of the thing that you want to do in managing your money is not necessarily just, I've got to get in right now because stocks are just leaving me behind. That's typically the point that you want to be a little bit careful about jumping in the market. Let the market come back to you. It's not going to correct a lot, mind you. We'll get a correction of 4, 5, 6, 7%, come back down to some of these moving averages, and there's a lot of support in the markets right now. From where we are, we've got the 20-day, the 50, and the 100-day all sitting well above the 200-day moving average. So there's a lot of support on the way down for this market to correct to, hold those supports, work off some of the overbought condition, and give you a better opportunity to enter the market and add some exposure to portfolios. The most logical place for a correction is about 4,000, 4,010, 4,020 on the S&P, somewhere in there. That's kind of that previous range that we were in back in May. That's along all these tops that we were setting from the beginning of the year. So we've had this very clear breakout of the market of that trading range that really began back in January. We broke out of that, set a new high for the year. We're now at a 52-week high as well. Funny story about that. I was doing an interview on Fox Business, and Charles Payne says, we've had a new high after 360 days. 52-week high after 360 trading days. Yeah, that's exactly what 360 trading days is. It's 52 weeks. So that's why it's a 52-week high. But I didn't say that to Charles Payne. I respect him too much. Anyway, the point is that yes, we've had a 52-week high. Normally this suggests that whatever negative trend you had previously is now over, and your odds are that markets are going to wind up higher. But it's going to have a correction along the way first. Now, what will cause it? That's a totally different story, right? You would think that, and we'll kind of talk about this with Michael Leibowitz here in just a couple of minutes, but with the Fed speech yesterday, certainly wasn't the dovish expectation that markets have been hoping for, but yet markets didn't really blink that much. They sold off a little bit on the initial announcement, recovered, finished about flat for the day across the board. But again, with a realization that any rate cuts are not coming soon, you would have expected maybe that might have pulled some of the wind out of the markets. But again, this is the problem with the market right now. You have a lot of exuberance in the markets. There is a lot of exuberance, and greed factors are really starting to rise rapidly here. So again, this market can remain, as John Maynard Keynes once said, this market can remain illogical longer than you can remain solvent. So the potential of trying to short this market right now, certainly not to your advantage at all. So just be very careful with that at the moment. So anyway, lots of stuff going on. Again, get by the website. Michael Leibowitz did write an article. We had a 2-part article on our website about sector rotations, something that we've talked about a lot recently. Part 2 was out yesterday on the website. So go by realinvestmentadvice.com, get a copy of that article. While you're there, also make sure you subscribe for our newsletter. We'll have that out this weekend, talking a little bit about this market and kind of where we go to next. What's the potential and where, if you get a correction, where will that correction likely find support? So that's going to be on the weekend newsletter at the website, realinvestmentadvice.com. Subscribe. We'll email it to you on Saturday as soon as I get it done. I get up early on Saturday to write it just for you, so make sure you read it. All right, be right back after the break with Michael Leibowitz. Don't go away.
Get daily investment news you can use, delivered at the speed of the internet at realinvestmentadvice.com.
Oh, Red, I declare, I plumb missed that candy coffee. Whatever am I gonna do?
Don't you worry, little darling. We'll watch it again on our YouTube channel.
Why, Red, I I never.
The Real Investment Show YouTube channel has all of our past presentations, from Candid Coffee and Lunch and Learn to special topic discussions, and all of our live show recordings preserved for you. Subscribe now to the Real Investment Show YouTube channel, or look for the link on our website at realinvestmentadvice.com.
Hi, Lance Roberts here. If you're like most people, your 401k plan represents the bulk of your retirement assets, and unfortunately for many, managing your 401k plan can be difficult. There's so many choices, so many things to consider. With just a quick email, a couple of questions, you can put RIA advisors to work for you managing your 401k plan. Get started right now at the website, realinvestmentadvice.com, or simply call our toll-free number, 855-RIA-PLAN, or again, simply online at realinvestmentadvice.com.
Health and financial security touches everyone within your organization. Offering benefits for all doesn't need to be complicated. Hi, I'm Tom Allen, Senior Benefits Consultant at RIA Advisors. RIA Benefits provides independent expertise to find solutions that speak to the mission of your business, the culture you want to establish, and the budget you are able to work within. Book a free consultation with me at realinvestmentadvice.com/retirement, and we'll find a solution that takes care of your most important asset, your people. realinvestmentadvice.com/retirement, realinvestmentadvice.com.
And now, another page from the Real Investment Advisors Investing Manifesto. Bulls win in bull markets. Bears win in bear markets. Eagles soar above and take advantage of opportunity. Let us help you soar as you reach your financial goals with RIA Advisors. Neither bull nor bear. RIA Advisors, 281-501-1791, or online at realinvestmentadvice.com.
The Real Investment Show.
And welcome back to the show. Of course, it is Thursday. It is the post-FOMC meeting day. And as we said, Michael Lee was joining me this morning to talk about it. So, again, yesterday, the markets rallied pretty strongly out of the gate, was, making its move higher on kind of the expectation the Fed was going to just pause, period. And, of course, if the Fed pauses, the expectation is that the Fed will then begin to cut rates. And, of course, you have to ask the question, the logical question is, why would the Fed cut rates? And you're talking about substantially lower rates of inflation, slower economic growth, these type of things. And the reason they cut rates is obviously to help provide that support for a slowing economic environment. So the Fed meeting comes out, and, of course, the initial announcement is they do indeed pause, which was highly expected. The problem for the market came when they actually looked at the dot plot, which suggested, though, that there are potentially for 2 more rate hikes this year. So, in other words, it was a very hawkish pause, I guess you could say, because everybody was expecting them just to pause and be done, but not this idea of potentially 2 more rate hikes in the cake. So that took the market by a little bit of surprise. Markets sold off initially, and then, of course, Jerome Powell started speaking, and then markets kind of recovered and finished the day flat as, kind of some of the conversation, which we'll get into this morning, suggests that maybe it's kind of a dovish, hawkish kind of pause thing. Who knows? Anyway, the market is trying to find a reason to be bullish right now. So anyway, Mike, welcome to the show this morning. What was your initial takeaway from the meeting yesterday?
You know what? I think we're getting into a new part of the Fed rate cycle where they're basically telling us we're at the end of the line. Now, whether there's 1 or 2 more stations left on this track, could be, but we're at the end of the line. I think what's more important is not necessarily whether the Fed does 1 or more, but what do they do? When do they start cutting rates? And I think that's where the market remains very much different from what the Fed thinks, right? If you remember, we were talking in February, March, and the market thought the Fed would cut Fed funds rate by 1.5 at one point by the end of this year. Now there's a 7% chance they cut rates by the end of this year. So the market caught up with the Fed in this case. If we look at Fed funds futures for next year, they're expecting 1.25% of rate cuts. The Fed thinks, based on what they said yesterday, based on their quote unquote dot plots, that they'll cut by about 50 basis points. So So, but the market is implying a 70% chance that they raise by 25. So in the short run, I think the market and the Fed are on the same page, but I think the market is waiting for this moment. And that moment is when the Fed starts cutting. Market thinks they'll start cutting aggressively. Fed thinks they're just going to inch Fed funds down. Maybe every 3 meetings, they drop rates by 25. So what I keep thinking about is exactly what you said, Lance. Why would they cut rates? And there's basically, I think, 2 reasons or 3 reasons they'd cut rates. One is that we have a crisis going on, a geopolitical crisis, something else that will really hurt the economy, and they see it coming, and they cut rates. The other is the economy itself. We just go into a recession, or growth really starts slowing, or unemployment starts rising much quicker. That's kind of a second reason, which there are really no signs of. There's certainly signs of slowing economic growth, but very few signs that the labor market's cooling off. And then the other one is that inflation just comes down sharply. And then the Fed just gradually lowers rates. So when you look at what the Fed thinks, that's what they think, that inflation will just continue gradually lower, but the economy and employment aren't going to be in a recession, and that they can just slowly decrease rates. That sounds great. That sounds perfect in theory, but that's never happened. The Fed always drops rates aggressively, because when rates are much higher than the economic growth, the potential economic growth of the economy, you get a recession. And here we are today with Fed funds at 5 to 5.25% in an economy that's really a sub 2% economy. The Fed is really putting the brakes on this economy. The economy is just not slowing down yet.
Yeah, and it's kind of interesting because even Jerome Powell made that mention. He says there's no real sign of recession right now. And I thought this quote was in particular. He says, "It will be appropriate to cut rates at such time as inflation is coming down really significantly." And again, we're talking about a couple of years out. As anyone can see, not a single person on the committee wrote down a rate cut this year, nor do I think it will at all likely be appropriate. But again, this goes back to what you're saying, is that in order for the Fed to be cutting rates, when he's saying that inflation has to really be coming down significantly, he's not talking about, it just slowing down at,
Right.
to doing 2%, 0.02% a month. He's talking about a very steep decline in inflation or deflation, which would be coincident with the onset of a recession. So again, the misread, I think, by the markets is okay, we're done hiking and some gradual cuts are going to come along, and now we're going to restart QE, and this expectation of return of liquidity and monetary accommodation, I think, is the part that the market is misreading at this point.
Yeah, and here's the other thing. When we talk about inflation, there's 42,000 ways to calculate inflation that the Fed looks at. Forget the other 82,000 ways. So, we're going to look at core CPI fell to 4.1%.
Yeah.
From I want to say 4.8 or 4.9. Next month, it's going to fall to the low 3s. That's the year-over-year rate, and that's solely a function of what happened a year ago when inflation was almost rising 1% a month. We know that will happen. So the headlines are going to say that inflation is at 3%, and it'll probably drop into the upper 2s as we get kind of later into the summer, early fall.
Yep.
So the market's going to be saying, wait, inflation is 3%, maybe even below 3%. PPI is now almost flat, and PPI will probably go either to 0 or negative, which is a good leading indicator of CPI. And the market's going to start questioning the Fed, right? The market will say, look, we know we're not at 2%, but we're also not at 7% or 8%. We've come a long way. Why aren't you doing anything? And the Fed is going to say, well, if you look at core services, excluding housing, with this, with that, it's still sticky. And yes, there are components of inflation that remain sticky, but those are starting to come down as well. So I think the Fed's going to start running out of inflation excuses. But if the economy remains hot, it's hard to see why they would really want to lower rates by a significant amount. Maybe a token 25 basis points here or there, which is kind of what they're telling you. But if I'm them, I want to save that the ability to cut rates significantly until we get into a recession.
Right.
So, try to put yourself in Jerome Powell's shoes. Not, everyone kind of puts themselves into the market views and what the popular narratives are and what you read on CNBC and MarketWatch. But put yourself in Jerome Powell's shoes and think about the potential problems down the road and what he can do if we go into a deep recession.
That's right. And again, this is the risk that the markets run right now, is this kind of this deviation between what they keep hoping for. And again, markets are running up on expectations of more liquidity and, looser or easier monetary conditions, despite the fact that really we're not seeing that. And again, while we talk about unemployment, we still really haven't seen the effect of 5.25% rate hikes at this point, from the March lows of last year. We've had a very aggressive rate hiking campaign that is really yet to truly impact a lot of the economy. We're seeing bits of it, but we haven't really seen that impact of higher rates. Corporate profit margins are still high, still very elevated. Companies have been able to maintain those corporate profit margins so far, but the question becomes, how long can they do that until the consumer really starts to slow down here and those margins have to decline in order to make sales? And that's going to be one of the things that is coming down the road, that markets are pricing in a very aggressive earnings increase between now and 2024 that may or may not occur. And if we don't see earnings begin to really recover sharply, and which would suggest a very strong economic growth environment, it's going to be really hard to justify valuations where they currently are. So, the problem I think that the Fed's going to have, and particularly if the market is right, is that you start seeing earnings recover, economic growth pick back up, then all of a sudden inflation isn't going to go back to where they thought it was.
Right. And that's the Fed's biggest concern, is that you get a dip in inflation and then it comes right back up. And that was the 1970s. That's what kept happening. And that's, I think Powell's been reading a lot of history books, and that's his fear. And that's what he's trying to ensure does not occur this time.
Yeah. I thought this was kind of, talking about some of the commentary that came out. One of the things that he had talked about yesterday, and again, when the initial meeting came out, or the initial minutes came out, it basically talked about a skip, and we're not going to hike rates now. We're skipping this meeting. One of the reasons the market rallied back yesterday was because Jerome Powell really didn't commit to a skip in his press conference, which the markets took as, oh, well, maybe this is a permanent pause, and maybe they aren't going to hike anymore. And that's one of the reasons the market rallied back. Jeff Gundlach out yesterday saying the same thing. He thinks the market, or the Fed, is done hiking rates at this point. I guess we'll see. All right, when we come back from the break, we'll talk a little bit about what's going on with the markets, obviously, and we're starting to get pretty extended here, pretty overly bullish. Kind of how to navigate this from here. We'll talk about that with Michael Leibowitz right after the break. Don't go away.
Investment Advice blog. It's required reading for the informed investor. Catch it today at realinvestmentadvice.com.
Oh, Red, I declare, I plumb missed that candy coffee. Whatever am I gonna do?
Don't you worry, little darling. We'll watch it again on our YouTube channel.
Why, Red, I I never.
The Real Investment Show YouTube channel has all of our past presentations, from Candid Coffee and Lunch and Learn to special topic discussions, and all of our live show recordings preserved for you. Subscribe now to the Real Investment Show YouTube channel, or look for the link on our website at realinvestmentadvice.com.
Health and financial security touches everyone within your organization. Offering benefits for all doesn't need to be complicated. Hi, I'm Tom Allen, Senior Benefits Consultant at RIA Advisors. RIA Benefits provides independent expertise to find solutions that speak to the mission of your business, the culture you want to establish, and the budget you are able to work within. Book a free consultation with me at realinvestmentadvice.com/retirement, and we'll find a solution that takes care of your most important asset, your people. realinvestmentadvice.com/retirement, realinvestmentadvice.com.
You're listening to The Real Investment Show.
In 1999, a parafiduciary group of financial advisors were busted by corporate giants for trying to operate in their clients' best interest. These men promptly escaped from a high-cost margin environment to the Houston Energy Corridor. Today, still excoriated by their former employers, they survive as protectors of others' fortunes. If you have a problem about preserving capital, if no one else can help, and you can find them right here, maybe you should hire the RIA team.
Can't catch the whole show now? Listen to our podcast later at realinvestmentadvice.com.
You pull something out of your refrigerator, it says the expiration date was like 3 weeks ago. Now, I know you've all done this. You eat it anyway.
The Real Investment Show podcast.
My daughter is a good example of this. If the milk is 1 day past the expiration date, she will not drink it.
Same show, your schedule.
Now, the expiration date's a safety margin. Give it the sniff test. You drink sour milk once. That is the only lesson you will ever need to learn in life.
At realinvestmentadvice.com.
And now, another page from the Real Investment Advisors Investing Manifesto. A passive investment portfolio requires active risk management. It's not a choice, it's necessity. Diversification doesn't protect against risk of loss. Let us actively help you reach your financial goals with RIA Advisors. Neither bull nor bear. RIA Advisors, 281-501-1791, or online at realinvestmentadvice.com.
Real Investment Show podcasts are now available from Stitcher Smart Radio at Stitcher.com.
Hi, Lance Roberts here. If you're like most people, your 401k plan represents the bulk of your retirement assets, and unfortunately for many, managing your 401k plan can be difficult. There's so many choices, so many things to consider. With just a quick email, a couple of questions, you can put RIA Advisors to work for you managing your 401k plan. It's a quick and easy application. Just simply click Ask a Question at realinvestmentadvice.com or give us a call at 855-RIA-PLAN. That's realinvestmentadvice.com.
The Real Investment Show YouTube channel has all our videos ready for your easy access. Now with the new and improved Before the Bell report, Candid Coffee, and Lunch and Learn replays, plus each day's radio show. Subscribe and bookmark our YouTube channel, or just click on the show links at realinvestmentadvice.com.
You're listening to The Real Investment Show.
So in this environment then, you obviously don't like risk assets. If you think that the stock market is in, at least part of it is in what you're describing to be, I don't want to use, you didn't use the word bubble, but it sounds like you're describing something like that in a certain part of the market. What do you like here and now?
Again, I haven't really changed my game plan for about a year and a half, maybe even coming on a year and 3/4. And that is systematic upgrading in fixed income portfolios. This is the perfect time to do that because we've had, with the stock market going up, a pretty nice rebound and a bid that was completely absent a few months ago, even in CCC assets, which are doing well in the junk bond market. But I think this is the time you want to have a barbelled portfolio with some risk assets, primarily in bonds. In the past, we spoke, Scott, of a 30-60-10 type of portfolio, stocks 30, bonds 60, and then something like gold, maybe 10%. That's just a proxy for some sort of real asset. Take your pick, your real asset of choice. But now I think you should be 20% stocks, 60% bonds, and 20% in that real asset. The fixed income market is very cheap compared to the stock market. I've talked about this. You can get 5% in a very high-grade bond portfolio with no default risk. You can get 8, 9, 10% in a well-positioned, actively managed fixed income portfolio that is taking middle part of the capital structure. At this juncture, triple C, I don't like at all. You know, even single B, I think is starting to be something you might want to upgrade in away from higher up. You can get all these yields, and you have all this upside. What people don't understand is thanks to the fact that rates went up a lot, and the fact that spreads on risk assets and bonds are somewhat elevated. They're down from where they were, but they're at about 450 basis points. I mean, you're talking about prices that have went from 100 on these credit bonds down to 80, 70, 60, 50 because of those rate increases and some of the fears. When you buy risky credit or moderately risky credit in fixed income at a price of 100, you've got a really bad proposition because they can't go up very much. If the prices go up, they'll just refinance them because the prices going up means that they can do new issue bonds at lower yields. So they'll refinance them and they'll take your coupon away. But and you have all that downside. If you start out at 100, you can go to 80, 70, 60, 50, which is what happened. But if you start out with a portfolio of bonds at 60 or 65 cents on the dollar, you've got 50% upside to par. You have stock market-like upside, maybe even, I would argue, even greater upside than the stock market.
And that was Jeff Gundlach from Double Line on CNBC yesterday talking about the market and making really kind of two key points about where the market is right now. And the first is he was talking about 20% stock, 60% bonds, which is, you know, you're sitting to scratch your heads like, well, why would you want to do that in this market? I mean, it's just the market's just going crazy right now. Market's up, 13% for the year. Why would I want to do that? His point is that valuations aren't supportive of where company earnings are right now. Semiconductors in particular. If you take a look at what's going on with the SOX index as an example, the SOX index has been screaming higher on expectations of, AI and what that's going to mean for, these companies. Yet semiconductor sales globally actually took a downturn. And even recent forecasts don't show the type of growth in semiconductor sales that would support the valuations of a company like NVIDIA, as an example, trading at 40 times price to sales. So what he's saying is that fixed income offers both something that the market doesn't provide, which is protection of principal, but also offers significant upside, even in high quality bond portfolios. In other words, there's plenty of treasuries out there that are yielding 3.5%, 4.5%, 5%, where you have absolutely no credit risk whatsoever. Step down that curve a bit, those returns get predominantly larger. And again, so when you start thinking about building your portfolio and these type of things, it's easy to get kind of swept up into this bullish nature of the market. And, with markets running up and really seeming not to worry about any risk at all, it certainly seems logical to just pile into equities. But again, you have to come back and look at valuations, earnings growth potentials, those type of things. Mike, I don't know if you could hear the interview, but your thoughts on that?
Yeah, I couldn't hear the interview, but based on kind of what you said there,
from these valuations,
I think this is what makes investing very tricky, is that you take a company like NVIDIA, whose earnings I think were actually down a hair from a year prior, but there's so much promise in AI that the future growth is tremendous. Now, as a investor, a long-term investor, you buy NVIDIA and you're buying into that future growth. But unfortunately, the market goes back and forth. Sometimes it loves the idea of future growth. Other times it becomes very focused on what's happening here and now. And it waffles back and forth. So, the last few months, AI, that's what the market's focused on. Yeah. And the potential growth associated with AI. But the market can change. And all of a sudden it can say, well, what about a recession by December? What about slowing sales, a consumer that's finally struggling? What about a rising unemployment rate? And you go back and forth. I mean, remember, tech stocks struggled late last year. AI was around last year. AI isn't a brand new invention. If you think about it, you use AI all the time, whether you're using like Google Maps or Waze. There are plenty of things that you use have AI embedded in it. So, that's why you're trying to always latch on to the market narrative. And a lot of times the market narrative isn't what's really going on the ground. And that's, there are times where those divergences are huge. And that's, where it becomes very difficult to follow a trend or to go against a trend.
Right. And it's something that, he made a point of. He says, and this is a quote from his interview. He says, then you got the S&P 500, which is really the 493 other stocks outside of the top 7, which have gotten a little bit of a tailwind lately. And this is something you've been writing about over the last couple of weeks on our website, talking about sector rotations. And, what was going to eventually happen here is that we would see a rotation into some of these other stocks. And we've been seeing a little bit of that. We've seen a little bit of broadness in the markets over the last week or so, which has been encouraging. It hasn't been so heavily concentrated in those top 7 stocks. But again, it's still predominantly dominated. Even yesterday's move was predominantly dominated by NVIDIA and Apple and Microsoft that were really kind of dragging the whole market higher. He goes, the stock market, frankly, this is Jeff Gundlach from Double Line, the stock market, frankly, is exhibiting signs of a bit of a mania where you have a very concentrated part of the market that's driving the entire train. And this is, this was kind of his point of downgrading equity exposure in portfolios from 30, in his model, from 30% to 20%, because of simply valuations, the ability for earnings to grow at a rate to justify some of these things. Now, that doesn't mean all stocks, right? There are, and you and I have talked about it, previously here on the show. There's a lot of companies that are trading at very cheap valuations. They have no love whatsoever from the market right now, even though they're cheap fundamentally because they're not in the top 10 stocks of, any ETF, right? So they're not catching all these passive inflows. They're certainly not catching on to, the AI train. But there's a lot of very cheap companies that pay nice dividend yields that will give you long-term returns, but those are not what investors want to buy right now.
Right. And you have to kind of, which hat are you going to put on? Are you going to be the investor that's willing to buy that stock, hold it for 10 years, and you probably are guaranteed a pretty good rate of return for 10 years, but you could suffer for 1 or 2 more years before the returns improve? Mm-hmm. Or you're going to buy one of these AI stocks that's priced for tremendous growth. Can it get there? Maybe, maybe not. But that's the trend. That's the trade. And, the answer is a little bit of both. You can't put all your money into the AI stock because it is a mania. And some of them will come back down to earth because the sales and earnings that's expected just are not attainable. It's just too high, even if some of these pie in the sky forecasts come true.
Right.
But you also can't, you can't sit in all deep value stocks because they become even deeper value because their price keeps dropping.
Right. That's the issue, and that's what's frustrating for investors, and particularly that's been the case this year. If your portfolio is anything other than 7 stocks, you're really probably dragging behind the overall market. This is a problem that a lot of portfolio managers are having this year, because just from being a good, prudent steward of capital, you wouldn't shove all of your clients' money into NVIDIA, right? It may seem like a wise idea. But, this is, and it's amazing how fast people forgot that NVIDIA lost 50, 60, 70% of its value just last year. And yes, it's gotten it all back in a very short time frame, but that usually doesn't happen, in the marketplace. This is kind of a one-off, but you can suffer very big losses, and we'll likely probably see another downturn like that again with NVIDIA in particular, as sales don't mature as fast as the market expects. And just as a good example we talked about before is that when things are coming along like this and there's so much demand for AI that this is going to drag in new competitors into the market, that's going to dilute market share, that's going to dilute earnings. AMD just announced a new AI chip as well. It's already getting adopted potentially by companies to run their AI services, and that's taking away from those $250,000 GPUs that NVIDIA was planning on selling. So this is all going to become a very interesting market cycle as we go forward. But the important part here is to always focus on preservation of capital, invest in things that will grow over time, make you money, pay you a dividend while you're waiting, and protect your capital on the downside. All right, quick break. We'll come back, finish up the show with Michael Leibowitz. Don't go away.
Get daily investment news you can use, delivered at the speed of the internet at realinvestmentadvice.com.
Oh, Red, I declare, I plumb missed that candy coffee. Whatever am I gonna do?
Don't you worry, little darling. We'll watch it again on our YouTube channel.
Why, Red, I never.
The Real Investment Show YouTube channel has all of our past presentations, from Candid Coffee and Lunch and Learn to special topic discussions, and all of our live show recordings preserved for you. Subscribe now to the Real Investment Show YouTube channel, or look for the link on our website at realinvestmentadvice.com.
Hi, Lance Roberts here. If you're like most people, your 401k plan represents the bulk of your retirement assets, and unfortunately for many, managing your 401k plan can be difficult. There's so many choices, so many things to consider. With just a quick email, a couple of questions, you can put RIA advisors to work for you managing your 401k plan. Get started right now at the website, realinvestmentadvice.com, or simply call our toll-free number, 855-RIA-PLAN at realinvestmentadvice.com.
Small businesses are now being challenged by the lack of employees and how to attract and recruit the best employees. To get the better employee, you'll have to offer a better package. Hi, I'm Tom Allen, RIA Advisors Retirement Plan Consultant. Don't assume a 401k plan is too costly or complicated for your small business to offer. Let us show you how to make the most of an affordable and effective plan that will deliver true value for your business and your employees. Call me toll-free at 855-RIA-PLAN or online at realinvestmentadvice.com. That's realinvestmentadvice.com.
And now, another page from the Real Investment Advisors Investing Manifesto. Manage risk and volatility rather than trying to manage gains. You don't have to be right all the time. Long-term investing success is a 70% gain. Let us help you reach your financial goals with RIA Advisors. Neither bull nor bear. RIA Advisors, 281-501-1791 or online at realinvestmentadvice.com.
The Real Investment Show.
And welcome back to the show. Getting ready to kind of wrap things up this morning. Retail sales out this morning, and this is going to be the next kind of batch of data to take a look at. Expectations right now are retail sales month over month for May is negative 0.1% expected, and that was down from a 0.4 previously. Retail sales excluding autos and gas are expected to be up 0.1%. However, credit card spending data suggests these numbers could come in quite a bit stronger this morning. And again, Mike, this is going to kind of be another conundrum for the Fed, right? Is retail sales really aren't slowing down as much as the Fed would like. And again, kind of going back to talking about, this kind of reacceleration of inflation potential that comes from the consumer, right? If the consumers are out there actively buying stuff and keeping prices elevated, and companies can go, oh, look, we're selling our widget for $1. We raise it to $1.20 and they're still buying it. Let's raise it to $1.30. Oh, look, they're still buying it. That's inflation. What the Fed's wanting is for companies to have to go, look, I've got to cut my widget from $1 to 90 cents to try to get it sold. That's what the Fed's trying to get to. But retail consumers really aren't playing along with the game like they're supposed to here. So, this is going to be kind of interesting to look at the report this morning. What do you think's going to? What are your expectations?
The problem with retail sales is it's nominal. It's based on prices, how much you actually paid for something, versus it doesn't strip out inflation. And there's no great way to strip out inflation from retail sales, because it should be based on the inflation is based on what actually sold, not a basket of goods as defined by the BLS. So the number has been pretty volatile versus expectations, and a lot of that is inflation. And inflation is also what's behind some of these corporate profits, both gains and losses. Some companies have been able to pass on inflation plus a little extra that helps their margins. Other companies are struggling to pass on inflation that can hurt their margins. So inflation is a big deal for many reasons, but kind of one of the underappreciated reasons is that it really screws around with our economic gauges. It's hard to know what's really going on when inflation is kind of not at that steady, 1.5%, 2%, and it's kind of baked into all the numbers. So when you look at something from this year versus last year, inflation was running at the same rate. It's easy to compare. So many comparisons, so many numbers are just skewed positively or negatively, every which way because of inflation. So retail sales is the hardest one. There's a thing called the Red Book, Johnson Red Book sales they come out weekly, and it's a proxy for retail sales. And they have been coming down now for about a year and a half, and this is growth. They're basically flat now. So they're basically showing no more growth in retail sales. And that's been a long, steady trend lower in the growth rate. So, and right now they're saying retail sales will be, let's call it zero, right? Zero. And then you add in inflation, which is running, 0.2% a month, 0.3% a month, is actually negative growth. So they're buying less, but they're paying more, which gets you back to kind of zero growth. But Lance, I don't know. I mean, it could surprise to the upside, like some of the credit card data is saying, but that number has been volatile, and it also gets revised significantly. So regardless of what they say today, when we go back and look at that number in 3 months, 6 months, or a year, it would have been.
And we just lost Mike there for a second. But yeah, no, this is going to be kind of one of the challenging issues is the revisions to the data, of course, and whether or not we actually continue to see this much slower rate of economic growth that everybody's been expecting, and we keep expecting this decline. Another good example of data coming out this morning that's really been stubborn is, of course, jobless claims. Jobless claims are out this morning, and they're expected to come in around 250. Normally, right, we don't even start talking about recession until we get jobless claims above 300,000. And have been, maintaining this 250 to 260 range now for months. Jobless claims just really don't seem to be picking up much at all, which again kind of belabors that point of the economy remains a lot more stubborn in terms of its resilience to higher rates and tighter monetary policy than not. And again, supposedly, we're continuing to see the Fed tighten monetary policy through both, higher rates and quantitative tightening, but yet none of that really seems to be the case. And if we take a look at the liquidity indexes, et cetera, liquidity has been rising in the markets. That's been helping boost asset prices here recently. So it really doesn't seem like the brakes are on as hard as it may look at the surface, right?
Right. There's can you hear me okay?
Yep. Gotcha.
There's a term called labor hoarding, and it's pretty interesting, and it's relatively kind of new term. And basically what it says is that it was so hard to find employees for the last few years that companies are hoarding labor. So they may not have a need for some of this labor, or they may not have 40 hours of work for some of these employees, but they're holding on to them for fear that if they lose them, they won't be able to replace them in the future. So this is another reason why monetary policy is not having the effect, not putting on the brakes like it normally would, because companies are not firing people. Jobless claims have ticked up, and they're not at obscenely low levels anymore. They're kind of back to averages, but trending higher. But there's nothing concerning in the employment data that would lead us to believe that the labor market is going to cool off significantly. However, when the economy slows, if it does, and this is all circular because it's hard for the economy to slow without people being laid off. So, once this circular engine, and if it does, kind of gets into motion, I think labor hoarding goes away, because it then becomes, do you want profits or do you want to hold on to people that aren't working?
Yep.
And that's kind of the age-old question.
It's interesting, though, you said that this is a fairly new term. I want to read to you something here real quick. Since the end of the financial crisis, businesses have been increasing bottom line profitability by massive cost cuts rather than increases in revenue. Of course, one of the highest costs to any business is labor. one way that one could measure the view is, of course, look at corporate profits per employee. The problem that businesses are beginning to face is that while they have slashed labor costs to the bone, there's a point where businesses simply cannot cut any further. At this point, businesses have begun to hoard what labor they have, maximize that labor force's productivity, and increase that productivity through additional employment of technology. That was this really smart guy that wrote this back in 2015. Which, this has actually been a problem that we've been talking about for a long time. Oh, I was the guy that wrote that, by the way, back in 2015, because this is the same thing we saw back then coming out of the financial crisis. We're now seeing that same type of issue again, to your point, Mike, which is they don't want to get rid of labor, and it's better to supplement the labor they have with increases in technology, which is now why AI is such a hot thing.
Right. So Lance, but let's also look where the jobs have been for the last year. Every labor report has shown it's in the services, in like the restaurant business, entertainment, travel businesses, right? That's where the labor has really been added. And, when the wheels start coming off, that's probably where they're going to come from. My daughter is in New York for the summer. She has an internship, but she's waiting tables to make some extra money. Her first day there, she walks down the street, puts a resume in at 6 restaurants, and has 4 offers. Mm-hmm. So they are still desperately in need of help at restaurants. They're you probably see it in Houston when you go out to eat. These restaurants are still crowded.
Yeah, and that goes back to the point of retail sales. I mean, despite right. higher rates and everything else, and supposedly a slowing economy, restaurants are full.
And the problem is,
and the cost is high.
Right. And what's going to change it? What's going to change it is when people start getting laid off. But because then you start changing your habits. Oh, my neighbor got laid off. Maybe we're not going to go out to eat this week. Let's save a little bit of money. But your neighbor's not getting laid off. No one's getting laid off. So again, it's this circular issue. When will the labor market feel it? And then that puts the whole recession thing into motion. But again, until we see the employment market markedly change, the odds of a recession remain low. But the labor market can change quickly. And when the NBER does call recessions, which they do in hindsight, and they revise them, we've seen that employment rises rapidly as the recession starts.
That's
so.
Right.
Just because we don't see it doesn't mean it can't happen quickly either.
Right. But this is the big challenge for managing money, though. Right now, markets are bullish, prices are rising, people want to be invested, people want to make money, and the fears of recession are receding rather rapidly here. So, but again, also too, that's the way psychology works in the market. Everybody was expecting a recession last year, which means it's probably not going to happen. And now that everybody's not expecting a recession, now, maybe we can actually have one. So we'll see what eventually happens. Okay, thanks, Mike. Appreciate it very much. That wraps up the show for the day. Next week, we're going to be on for 2 hours from 6 to 8 a.m. And we'll be using from 7 to 8 to take live questions all week. So we'll be taking your questions next week from 7 to 8 a.m. right here on The Real Investment Show. So tune in next week. It'll be a lot of fun. Also, be sure to get by the website, subscribe for our newsletter. It'll be out this weekend. Mike's latest article on part 2 of sector rotation is on the website now. It's all there for you, realinvestmentadvice.com. Send your questions, comments, and emails, and stick around. We'll have our 3 minutes before the bell video coming out here in just a few minutes. Have a great day.